Hello, besties! How you been? It's officially March, and before we know it, knock knock, April will be here. Which also means before we know it, the IRS will be here, because it's that time of year again. It's tax season. And I know you're already stressing because, frankly, taxes are one of the most confusing parts of being an adult. How could they not be? We spend, at a minimum, 12 years in school learning things like math and science and reading. We regurgitate the Pythagorean theorem. We know that the mitochondria is the powerhouse of the cell, and you might even be able to name all 50 state capitals, but we don't teach personal finance in schools, and it's a shame. I've never needed to know what a past participle is in my real life, but I have worried that I would go to prison for filing my tax return wrong. It would have been nice to learn about this stuff. That said, today, we're gonna break down how taxes work, debunk a big misconception, and share how to lower your tax bill. Please like, comment, and subscribe to learn more about being good with your money. Let's get to it. So first and foremost, some of us still don't understand how marginal taxes work, but I can explain taxes to anyone. Stick with me here, and you'll get it in the next 2 minutes. Close your eyes and pretend you no longer get paid in money. Instead, now you get paid in pizzas. For the first 11,000 pizzas you get, pesto flavor. Ick. Everyone does. Doesn't matter if you're Richie Rich or Broke Becky, we all start with pesto flavor. And the government's like, we don't really like pesto that much, but we'll take 10% per pie. Once you start making more than 11,000 pizzas a year, you level up to the next flavor. And listen, it's not great, but it's mushroom, and it's still better than pesto. The government likes this a little bit more, but again, it's mushroom. They want 12% per pie. At this stage, nobody has gotten any good pizza toppings yet because we all level up at the same marks. Unfortunately for Broke Becky, that's kind of it for her. She's tapped out. She's not getting any other flavors. The government's not taking too much, but she didn't have much to begin with. Only getting pesto and mushroom isn't ideal. At the next level, we get sausage. And the government's like, yum, we want 22% per pie. Then pepperoni. Government takes 24%. You and I say we stop there. That's all the pizza we're getting. Richie Rich made 600,000 pizzas last year, so he's getting barbecue chicken and buffalo ranch and even Hawaiian. The government loves those pies, so they'll be taking 32, 35, and 37% respectively of each type. That's what marginal means. Your money, depending on how much you made, is categorized differently. When you move into a higher tax bracket, you aren't suddenly giving away a bigger percentage of every pizza you got, just more of the newest flavor. So what does this mean? It means that the conspiracy theorist from your high school is wrong. You will never be worse off if you make more money. I see a bunch of people on Facebook telling each other to turn down raises or not take overtime because they're worried it'll bump them up into the next tax bracket. But as we've just learned, moving into a higher tax bracket just gives a rough indication of the max you'll ever end up giving up in your top pizza flavor. It doesn't suddenly mean you're gonna give up more of your total income. This is all to say, always take the raise. Don't be afraid to work overtime. You'll end up with more money in your pocket. And without stating the obvious, nobody wants to pay more in taxes. So here are 6 ways to lower your tax bill. First off, if you are a W-2 employee, one of the easiest things you can do to legally avoid taxes is to contribute to a retirement account. Contributing to a traditional 401k or IRA, individual retirement account, will help reduce your taxable income, and the IRS will not be able to go after as much of your pot. Say you make $100,000 a year, put $20,000 into your 401k. The government can only tax you on $80,000 instead of that original $100,000. For 2023, the 401k maximum that you can contribute is $22,500 with an additional $7,500 if you are over the age of 50. And for your IRA, you can contribute up to $6,500 plus an additional $1,000 if you're over 50. On top of that, if you have a high deductible health plan, meaning you pay less upfront, but we may pay more if you need to actually get medical care, you can also open something called a health savings account, an HSA. And contributing to an HSA will reduce your taxable income. Even better, you can use the money in your account to fund any medical expenses tax-free. And if you don't end up using all of it, it's essentially just another 401k where you'll just pay income taxes on the money in retirement. Moving on, if you are self-employed, you can use your side hustle, passion project, or freelancer status to claim business deductions. Things like vehicle mileage if you're driving to a client site, shipping if you have to send your product out, advertising, so paid social that you're paying to Facebook or YouTube or Instagram. Website fees, for example, I host my website on Squarespace. I have to pay a fee for that. Professional publications, for example, I'm subscribed to the Wall Street Journal, the Financial Times, Barron's, and these all help me create content, and I gotta pay for that. On top of that, things like dues and memberships. So if you don't have a permanent office and you pay for a WeWork membership or a Soho House membership so you have somewhere to go, that can be written off as well. Office supplies like printers and ink, and even a percentage of home internet charges for Wi-Fi or telephone. You can also write off things like travel and business meals. In 2021 and 2022, you were able to write off 100% of the meal, and in 2023, you'll still be able to write off 50% of the meal. All you have to do is ensure you maintain proper records. You can also deduct half of your self-employment taxes. Yes, unfortunately, self-employed folks are responsible for paying 15.3% in taxes for the joy and the privilege of working for yourself. But the government will let you deduct 50% of the amount you paid for those taxes from your taxable income. And last but not least, if you are a homeowner, here are some big deductions you can take. First and foremost, you can deduct private mortgage insurance premiums. So essentially, if you have less than 20% equity in your home, chances are you pay something called PMI, private mortgage insurance. This coverage is required by lenders as a way to protect themselves if you stop making payments. You can deduct this from your total taxable income. And whether or not you have 20% equity in your home, you likely have a mortgage, and you can deduct mortgage interest. So for example, you have a home that is worth $750,000. You can deduct the amount you spend paying interest from your total taxable income. As always, this is just the tip of the iceberg, but if any of these tax saving strategies pique your interest, definitely mention them to your accountant or tax preparation professional. And to wrap up this video, I want to call out that if taxes stress you out, you're not alone. It's not embarrassing to ask for help. I call my accountant once a month to ask questions because tax rules are ever changing. Don't psych yourself out. You've got this. If you found this video helpful, make sure to like and subscribe for more money, spending, and finance tips. See you, besties.